A pharmaceutical company finds itself in the middle of an epic tug of war. Valeant Pharmaceuticals International sells some well-known drugs like toenail fungus medicine Jublia and Bausch & Lomb eye care products. Fueled by a merger in 2010 that moved its headquarters to tax-beneficial Canada, for a long time it was loved by Wall Street. The stock attracted big-name shareholders, delivering returns in just 5 years of more than 1,000%. Investors have been drawn to Valeant's philosophy that large pharma companies are spending too much on drug research without focusing enough on what they're getting for their money. When Valeant hits its high in August, veteran activist investor William Ackman is holding more than $3.8 billion in the stock. In October, a bombastic short seller named Andrew Left has his hands on an opposing bet. Left founded Citron Research. Citron is the French word for lemon, and writes an irreverent report that purees companies he thinks are, well, lemons. Ripples reverberate across Wall Street within minutes of Mr. Left hitting send on a Valeant evisceration. While short on specifics, Mr. Left alleges that Valeant is affiliated with 2 specialty pharmacies, including Philidor prescription services, that it uses to create invoices to deceive auditors and book revenue. The Wall Street Journal has reported that Valeant employees working at Philidor used fictitious names like Spider-Man alias Peter Parker in their emails. Valeant says it's found no evidence whatsoever of illegality, but has formed a board committee to look at the Philidor relationship and stop doing business with it. Philidor says it has adhered not only to all applicable laws, but to the highest standards of ethical business practice. Valeant's chief executive says Philidor now plans to cease operations by the end of January 2016. The sudden yank at Valeant's integrity catches investors like Mr. Ackman off guard. Valeant loses more than 2/3 from its all-time high in August. Long before Citron's report soured investor confidence, Valeant faced other questions about its business. The Wall Street Journal reported in April that Valeant had increased prices on 2 cardiac care drugs it acquired by more than 500% and 200%. Valeant said it was adjusting for the drug's market worth. Congress this summer started asking questions. By mid-October, Valeant had received subpoenas from federal prosecutors over its drug pricing and related issues. Valeant has said it intends to cooperate and that it's shifting away from price increases as a driver in its business model. Mr. Ackman isn't letting go of Valeant without a fight. He decides to invest even more on the belief that Valeant's risks are less serious than other investors believe. And with his investment losses nearing $2 billion, he holds a nearly 4-hour conference call defending Valeant's stock. In the middle of the call, a tweet by Mr. Left threatens more bad news. Valeant shares closed down nearly 16%. Mr. Left didn't end up making new accusations, but he subsequently slammed Mr. Ackman as lacking moral indignation against Valeant for its drug markups. He's irrelevant, Mr. Ackman says. The market thinks differently, responds Mr. Left. Mr. Ackman later revealed his firm boosted its stake again, this time to around 10% of the company. By late November, Valeant's stock price was trading around $90 a share, making up some of its previous losses, but still down from its August high of $262. Meanwhile, Valeant continues to make valiant attempts to win back investor confidence.